Good evening. This is the Angry Capitalist doing an update on the banking sector as of December 2023. I'm recording this 10 p.m. Eastern Time, December 20th. This will most likely be uploaded December 21st in the afternoon. All right, getting into it. So, for some brief context, we've had 5 banking failures throughout 2023. 3 of those being in May, then June, and then we had another in July. And I think one in September as of the most recent failure. So just giving a brief update on the situation with the banking sector. I'm going to go over a few key metrics. I'll try and give my best explanation for some of those for anyone who's not super familiar with the terminology and jargon that I'll be using. All right, so first off, we have deposit outflows. Effectively, this is as the bank takes in deposits, i.e. savings and checking, cash deposits that they have on hand for their customers. Deposit outflows refers to that number decreasing and the rate at which it's decreasing. Okay, so as of Q1 in 2023, with the banking collapse, or with the banking crisis in Q1 of 2023, we had deposit outflows of $473 billion. Going into Q2 and Q3 respectively, we had approximately $90 billion in outflows from deposits in both of those quarters as well. Liquidity ratio. So the liquidity ratio is the ratio of liquid assets to uninsured deposits. So if you go into your bank, you'll see that the FDIC insures accounts are insured up to $250,000. One metric that we look at for the health of a bank and the banking sector as a whole are those liquid assets. These would be bonds, treasury bills, other forms of cash or cash equivalents that the bank would have on hand. So if they have to liquidate assets, these are the most liquid assets that they can sell off to cover those deposits in the event of a bank collapse or a bank run. All right. So let's see. Going backwards in time, so as of Q3 of this year, the liquidity ratio has dropped down to 82%. In Q1 of 23, it was at 92%. So back in Q1, a 92% liquidity ratio, that's pretty healthy. We saw those outflows of deposits as well as the depreciation, or really the loss of value of banks' bond portfolios. So this is something. Hello there, my boy. Are you helping? Are you helping? Yes, you are. I love you. Sorry about that. So as we're looking at the health of a bank, one thing that can really affect them is if they have a lot of bonds in their portfolio. And as the Federal Reserve has increased bonds within the market, or has increased the interest rates for loans and various debt instruments going forward, the value of bonds that have interest rates below what current rates are set at, those values get decreased by quite a bit. So that's something that can really affect the liquidity ratio, especially if the market rate for those bonds, if the bank had to liquidate them, falls drastically. That's accounting for a lot of this. So once again, in Q3 of this year, that has dropped down to 82%. Back in Q1 of this year, it was at 92%. Actually, back in Q1 of 21, the liquidity ratio for the industry as a whole was at 103%. So we saw a very healthy liquidity ratio if anything did go wrong, the banks had the cash or cash equivalents to cover those losses for their depositors. Not so much anymore. It's still not horrible, but that is banking sector wide for the US. So there are banks out there that are in better and worse positions. Keep that in mind. Commercial real estate. One sec. The void is needy. Okay, so commercial real estate. You've probably seen this in the news quite a bit. Bear with me through some of the jargon here. Once again, I'll do my best to explain some of it. Okay. So something to keep in mind, you'll see this in the news that 44% of office leases or offices or office loans, my apologies. I'm reading my notes here. I'm a lefty. I've got horrible handwriting. So 44% of office loans are at risk. This is true. So if there's an office space, the so with offices, specifically office spaces, not all commercial real estate, they're looking at a vacancy rate right now of 17.8% as of October of this year. And that's up 16.3% from the year prior. So just within 1 year's time, so October of 23, coming back from October of 22, the vacancy rate in office spaces has spiked 16.3% to 17.8%. So approximately 44% of office loans, meaning loans for office spaces or office buildings, are at risk of defaulting. That does only make up, let's see, approximately 14% of the total commercial real estate market. But this trend will probably continue, both in terms of vacancy and of risk of defaulting. For the industry as a whole, approximately 12.8% of the bond or debt portfolio, or really approximately 12.8% of the banking industry's portfolio is made up of commercial real estate. If we look at the industry as a whole, that's one of the largest positions of the industry altogether. So between cash, residential mortgages, small business loans, credit card, etc., industry-wide, and although this varies from bank to bank, that's one of the largest positions in the banking sector's portfolio is commercial real estate. Going back to the issue with the liquidity ratio, and with the T-bonds. So these would be treasury bonds. So these are bonds or debt instruments issued by the federal government, which banks buy and hold. The theory being is that the U.S. government will never default on their debt. It'll happen someday. But the idea being is that is one of the most secure assets out there. So banks hold it, or banks tend to hold bonds as a form of safety net or a safety asset. That being said, once again, however, looking at the mentality of some of these banks, buying treasury bonds at historically low interest rates and holding those, very bad play in my opinion. Typically, if you're going to buy bonds, you want to buy bonds when interest rates are high. So with that in mind, unrealized losses on T-bonds. And what I refer to as unrealized losses is that you have the market rate of this bond, which if you were to resell it as of right now or as of the various dates or date stamps that I'm going to give out, this is how much you would have taken a hit on it for the banking industry wide. So keep that in mind. As interest rates go up, the value of bonds purchased at a lower rate in the marketplace goes down. That's what we're discussing. So unrealized losses on T-bonds. Q1 of 23, the industry lost about $516 billion. That loss had increased to a loss of $684 billion as of Q3 of 23. So even through the banking crisis to now, a lot of these banks are still losing money by holding these bonds that are becoming worth less and less every day. This also does bring us into a little bit of the consumer's position and the situation with consumers, specifically consumer debt. A few things to keep in mind. Once again, the health of a bank is largely dependent upon the ability of its borrowers to pay the bank back, as well as the trust that the depositors have to leave their deposits with the bank and to not draw them out in mass or to put those deposits into other assets that they may view as safer or more beneficial to own. So consumer debt as of November of 2023 has jumped to 17.9 trillion. So this includes various things such as credit card debt, auto loan debt, various other forms of just debt, personal loans, etc. That's what that's aggregating. Between Q2 to Q3 of 2023, we've seen an increase in consumer debt of approximately 1.3%. I know that doesn't sound like a lot, but remember, we're dealing with trillions and trillions of dollars here. Well, interest rates are also going up. So as this consumer debt is increasing, so too is the debt service or the cost of that debt that consumers have. Credit card debt in 2023 has increased by 4.7% as of November, and auto loans have increased by 0.8% as of 2023. One of the reasons why I think the auto loan debt levels have increased further is just because Americans have retracted on purchasing vehicles, especially newer vehicles, in 2023. As we have seen inflation increase, the cost of living increase, people just held off on buying a new car, or they're buying a used vehicle. Or, quite frankly, a lot of people are just having to fix their old car to keep going by. Credit card delinquencies has increased by 2.6% as of 2023. Now, this next segment here, I think this is very interesting and very telling. We still don't have a lot of information, concrete information out on this, but this is student debt. As of October of 2023, October to November of 2023, student debt effectively got turned back on. People had to start making payments again, and 40% of people who were set to start making payments again didn't. Now, this could be due to a few different reasons. If you look at a lot of the news outlets that are out there, some of them will try and put a positive spin on it, just stating that, it's a problem with the payment system, getting it back online. People don't know how to go about repaying their student loans. Like, they had all this time to figure it out and they just don't know how. Most economists out there are just, people don't have the extra funds to pay their student loans. They just don't have it on them. So that's going to be very interesting going forward in the months ahead. And I think that may be a straw that'll break the camel's back, so to speak. So this concludes the banking report for 2023. I hope to do at least one update on banking per month going forward as we go forward into this recession. Thank you all for watching. If you enjoyed this content or if you have any further questions about anything that I talked about or anything you want expanded on, please go ahead and drop that down in the comments below. If you like the video, like, subscribe, and especially if you like this format of content, go ahead and ring the bell so you'll get updates. Until then, I hope you have a good rest of your evening, and take care.